Welcome to another episode of the brand called You, a podcast and podcast show that brings you leadership lessons, knowledge, experience, and wisdom from thousands of successful individuals from around the world. I'm your host, Ashutosh Garg, and today I'm delighted to welcome a very senior professional from the world of real estate and investing from California, USA, Tiffany Alexander. Tiffany, welcome to the show.
Thank you. I appreciate it.
Thank you. Tiffany is a fund owner, a podcaster, and a super connector. So, Tiffany, let's start by asking you to tell me about your journey and what sparked your interest in real estate investing.
This is a great question. It's my favorite question because you would never think the journey that I embarked on when my entire childhood I wanted to be an astronaut growing up. And so that's what naturally I went to school for and exactly where I did go. And my
Oh, you can see the.
poster stapled
Mhm.
to the wall in my dorm room is now framed as a reminder that I will go to space. And it was actually several semesters in failing out of physics and loving math, realizing I don't think I'm cut out to finish this degree. And I landed myself from job to job to job at the airport in Orlando, where I worked for a long time. And I saw my very first late night infomercial that said, you can go flip houses for no money down. And I fit the bill. And it was actually, that was the exact pivotal moment when I realized, wow, I can do something entirely different. That's not my degree path and could shift my world into the start of real estate. And that was just the very beginning. And that was 19 years ago now.
And you've told me about how you decided to move from aerospace, or from space to real estate. What was the pivotal moment in your investment career, and what did it teach you?
I think the pivotal moment in jumping into real estate was thinking, oh my gosh, I've got this. I'm going to do flips. I'm going to do holds. I've done tax liens, tax deeds, commercial, residential, multifamily. And I had someone approach me and say, Tiff, why don't you just be the bank? And I thought, I know what I know, and I have no idea what you're talking about. Tell me more, please. I need to know now. And it shifted the entire uh, paradigm of my real estate investing, knowing that I could actually just be in control of the paper and not have to actually have the tenants or the contractors to deal with that stuff day in and day out. Because if you think about it, all of the biggest buildings in every single downtown, they're all banks. And banks, what do they own? Not the property, they own the paper. And someone taught me that. It's now coming up on 8 years ago. And that is what shifted me from being this landlord house flipper to being a paper owner, a bank now. And that is a pivotal moment for me. And that's where I'm at today and still the paper space.
Amazing. And as someone who has guided over 1,000 investors, what patterns do you see in those who succeed versus those who struggle?
It's a quote I'm totally going to butcher, but it belonged to Zig Ziglar. And he said, motivation is like bathing. You need to do it daily. And a lot of the trainings that I went to, whether I paid to be at them or I paid to host them, I paid to coordinate them, they all were over half of it was mental mindset, motivation, letting people know, hey, this is what you got to do because you have to keep showing back up and you have to keep getting through the no's until you're comfortable getting through all the no's. And then you need to start getting comfortable with all the yeses. And I'm just going to tell you in real estate, you're going to face a lot of no's, a lot of hardships, and a lot of like ups and downs. And when you can persevere through that, but also you're going to surround yourself with the right people because this is a space that you need to be in with the right people, not your naysayers, the ones that are going to keep you with your head held high to press forward to your next deal.
Amazing. So you were just telling me that now have a bank and you're a fund owner. My next question for you, Tiffany, is why is liquidity such a crucial concept for investors, especially in today's economic environment?
This is a wonderful direction to head. If you are at all borrowing, 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 and you are strapped up to your eyeballs and then the world takes a shift. We don't know where the economic impression is going to go left or right, and we
Yeah.
can get a feel, but nobody has a crystal ball. I believe that having a less amount that you owe on each property or each asset or each thing you're getting into, is going to behoove you the strongest. But what we do and we specialize in is when we go and we acquire these assets that are debt, we buy them at a lower amount than what the client even owes.
Right.
So we have the ability to remain not just liquid and owing less, because we've bought their loan for less, but also we have pools of people that want to sell them and pools of people constantly that want to buy them. And with us being the middleman, I have the ability to always add more assets and I have the ability to release the current assets that I have to be able to make it a safer, I'm not allowed to say that, a lower risk bet for
Mm.
people that want to do business in the manner of the way I'm doing business in notes.
Great response. But also the other perspective I wanted from you was, that a lot of the liquidity in investments is a function of the stage of life that you're at. I mean, I'm 68, and now I would rather stay in cash for most
Yes.
of my investments rather than with what I used to be when I was 38. What are your thoughts?
Absolutely. I 100% agree. So I believe that people are going to be facing these decisions to say,
Mhm.
hey, I'd like a medium risk, a high risk, a lower risk. And well, some of these things, they might be promising you a higher risk, but they're promising you a much higher yield or return. And that might be, oh, come and buy an apartment complex with me. We're going to hold it for 5 years and you'll get X amount of teen percentage or higher with these waterfalls and so much of it. And that stuff makes me uncomfortable to leave it for so long with that being a 5 year potential. I don't even know what's going to happen in 5 years. So when I say what we do is we can hold stuff for weeks, I can hold stuff for months, and being able to be that partner to bring these deals together allows what we do a more liquid type of asset to hold. When what's funny is it doesn't feel like it's a liquid asset. When you say, Tiff, what do you mean you buy paper? I buy notes that are in already in origination. They are already in existence. And I might buy 20 years of that piece of note that's left where you're thinking, I have to own that for another 20 years. No, you don't. It's a very liquid market because you've bought it at a discount and you can in turn sell it at a discount to someone else to liquefy your position pretty quickly.
Very well said. And therefore, a follow-up question for you, Tiffany, is what are some common liquidity myths investors fall for when building their portfolios?
Oh, it's all the things that are butterfly and glitter and rainbows that almost the falsities that people are telling you because they aren't as deep into the deal as you believe them to be. So some of the things that you're going to want to follow through with are how many deals have people done? What type of investment are you getting into? And hey, we can get you out only if the market conditions are perfect. You're going to need to have not just your A plan that you have planned out with somebody, but your what if that plan doesn't happen? What if this plan doesn't happen? And that tends to be the point where people are understanding this deal is potentially far less liquid than what they thought. So it's a matter of, even in the Bible, it says to have a multitude of counsel to be wise with the decisions that you make, to have multiple people that are experts in that industry look over the deals that you're getting into.
Very well said. But the other thing that I wanted to get your thoughts on was that real estate is typically known as being illiquid.
Yep.
How can an investor balance real estate with more liquid asset classes?
This is great, and I'm a firm believer. I've started my journey in the back in the day, and you have to read Rich Dad Poor Dad to kind of get your first elementary bringing up of understanding that you should have a diversification across your portfolio. And some of that could be all diversified within real estate itself, meaning when I started real estate, you can get involved in tax liens and tax deeds, and those are months to a few years. And then you get involved in owning the real estate yourself, whether it be a rental. Shorter portion of it would be a flip. But if a flip goes wrong, it becomes a rental.
Yep.
And then what happens here, and you can get into the spot where I like to be, which is having all the cash flow of a rental, but actually just owning the paper. And then there's even something a little bit more liquid, and it's not having ownership of the building, but control. And then you have control of the tenant that's moving into it. And you just get to be sandwiched in the middle without any of the ownership, but all the beauty of the cash flow.
You also speak about moving a portion of capital into securities, commodities, and crypto. Why
Yes.
these particular classes?
This is a great question, and this is not going to be the funnest answer, but my business partner, he is an expert at it.
Okay.
So I'm not the expert, but when I strapped this investor right to my shoulder and I thought, let's business partner up, he graduated exactly in the degree of knowing exactly how to invest in futures, commodities, and Bitcoin. And he has involved himself in creating algorithmic bots that trade that are managed. And with his track record of his portfolio, we decided that a very small portion of our fund should be diversified, not just 90% real estate or 100% real estate, but up to 10% should do something that is our backup plan. Like if all real estate goes to crap, that means Bitcoin's going to do its thing, or vice versa. If Bitcoin goes to crap, we've got 90% of our portfolio that's going to do low risk notes.
Amazing. And are there any asset classes you intentionally avoid for liquidity reasons? And if so, why?
I do. I avoid land in particular because it's not my strong suit. I know some people and they are my direct referral when someone says, Tiff, will you buy my land? I'm like, I won't, but I know a guy who will. And I know people that turn land easily. But because I never really studied it, I never grew comfortable with it. I'm okay with saying I'm a hard pass on stuff like just plain land.
Yeah, yeah, well said. My next question, Tiffany, is that what is the role of automation and trading technology to generate liquidity and returns? And I see a lot of people offering products which are, through hedge funds, which are doing back-to-back trading and so much more.
Those are great things to be tapped into, quite frankly, because if you have a level of risk that has a higher tolerance, or you have it's some people, it might be considered like gambling money that you're like, wow, I could get 100% on this money if I left it with this trading bot. AI is crushing it. And I think knowing that my business partner has invented algorithmic bots and he has seen black swan events happen again and again,
Mm.
that where the market has never done this before, even if you think you've perfected or you have this wonderful little system that is going to tell you exactly what to do, it still has to be monitored. It still has to be watched. And knowing that you should get involved in some of that stuff, it's just a matter of how far out is your date of retirement that you can absorb having a loss and coming back around
Yeah.
to recuperating potentially that loss and making sure still yet again, whoever's system you're getting into with AI, that's been tested over and over and over again, and someone is still watching it because nothing is completely flawless.
Mm. And how do you determine what percentage of your fund to keep liquid?
We tend to be able to liquefy at a moment's notice. So
Mm.
we will keep a lot of our money into deals, into physical notes.
Mm.
And when someone says, "Hey, I'd like to be removed from the fund," or "I want you need a portion of it back," it's actually a matter of an email, a text message, or saying, "Hey, I want out of this asset. Who wants this asset?" And
Mm.
that's what we're building up is a website where people can actually just tap into all the assets that we have. So we
Mm.
can become like a Costco to be more of a short-term hold
Mm.
for the portfolios that we are going to start having access to.
Well said. My next question is a billion-dollar question. What kind of news or economic events could trigger an investor to consider accessing their liquidity?
This is a great question, and I'm going to say it's who you hold close to your pocket.
Mm.
Meaning, I am a text and a phone call away from people that have already invented algorithmic bots that are analyzing and assessing what the world pulse is. So it's a matter of like, why did that guy say that in his speech? Why did this happen? Why did that happen over there? And assessing all these data points to see exactly why the market went this way or that way, depending on which market you're trading in. We actively only trade in the US market currently, but as you know, the crypto coins, they are global. So we have to watch those too to make sure where it's going to go. But also, if you're not comfortable with deciding what the news is doing and where it's going to go, you can actually incorporate these things called losses on either way, like a stop gain, a stop loss to
Mm.
decide, oh, I don't want my portfolio to absorb that much of a gain or a loss. It's implying, or sorry, putting all of these tips and tricks into action in your portfolio. And if you don't know, you better be trading with paper money in the meantime instead of real
Absolutely.
money.
Absolutely. And Tiffany, what advice would you give to new investors who want to jump in but are worried about not being able to access their money quickly?
That's a good question. They should determine how much money they need for whatever their buffer is. And this is going to be something that I can't even give blanket advice
Mm.
because I'm not licensed to give any kind of advice, but I am a good person at understanding like a litmus test of someone like,
Mm.
where are you at? What do you need? How quickly would you need it? How much can you absorb if your portfolio takes a hiccup? Because there are places that offer very low risk, like a
Yeah.
CD, that will get you a safe return, but at the cost of inflation right now, because they're not really outpacing inflation.
Yeah.
So it's just a safe way to hang on to your money and not lose it as fast as it could be if it was in cash. Uh, so it's going to be one of these things that you may not just want to have one conversation with one person, but somebody that has done all of this stuff, has done all of this stuff, and take a blend of what you are comfortable with.
Hmm.
But sometimes even what you're comfortable with may not be as intense of a strategy that you may need to employ. Because if you're starting late, we got to get you caught up somehow, or we got to get you doing something creative like no money down real estate, right?
Absolutely. Absolutely. And yet, most investors have their own set of expectations. How do you manage investor expectations when it comes to liquidity versus growth?
Ooh, this is good. I try to manage expectations to understand what they need, meaning, what do you need your portfolio to do for you? And if they don't even have an idea of what that looks like, we can actually go all the way back to saying, what would it be like if you held all of these pennies and dimes or your thousands or millions in your account in cash? What would it be like if you held it into a CD? Like, let's tick up the ladder of what your risk is according to your rate of return. And you start to almost feel like, oh, I can't risk that. Like the conversation is going to be individualized, saying, all right, well, can you do 8% somewhere if you can't access it for 12 months, but it's very low risk? Or can you do 12%? Or could you buy some notes? We can get you into a little bit higher of a return. Or do you want to manage the asset yourself? Or
Mm,
do you want to manage a rental yourself, which I would talk you out of that in a
yeah.
heartbeat?
Yeah.
Uh, or do you have enough millions to
Mm,
hire one of the better investors that can create a trading algorithmic bot for you to whatever it is that they're going to be trading? So there are so many different methods and ways to trade, whether it be on the open market, the crypto, the futures, the commodities, trading in real estate, all the way to really just getting into some of the top 50
mm,
stocks and funds that are in the United States Stock Exchange.
yeah.
Um, there's just so much variety. It's
Correct.
gonna be a blend. There, I don't think anybody should keep all their eggs in one basket. We
Correct.
should create like a tiered approach so that way we have cushion for whatever's gonna happen.
Fair. I have time for two more questions for you. Tiffany, what trends are you seeing in fund management as more investors demand flexibility and faster access to their funds?
I see that some funds are trying to make their funds that aren't only a hard set 5 years. A lot of the times I hear people say, well, you can lock it in, but I need your money for 5 years. And that was exactly what I didn't want to have with mine.
Yeah.
And so we made it a 12-month written request to remove themselves. But since we can't act as a bank, I can actually just say, hey, we don't have any use for the funds that you've requested right now. You can have them back next week. So the trend is trying to get investors to stay for that longer period of time to offer a little bit extra incentive. But even that extra incentive isn't worth the risk in my perspective of what they're doing, because what they're buying is apartment complexes to add value. And I
Mm,
don't see that the multifamily market is going to be holding steady with the high cost of insurance and
mm,
the high cost of being able to raise the debt or raise the money or borrow from banks, because the interest rates have gone up to higher than what we've had over the last 15 years. So they're having to reassess what it is they're offering to people, whether it be I can only do a flat rate or I can offer you a tiered rate. They're really trying to tap into some of these people that are just scared. So they're
mm,
having to try to create a level of comfort that they've never really had to create before, because people are unsure of where the market is going to go.
mm. Amazing. And my last question for you, Tiffany. What is one liquidity related principle that every investor should live by, no matter what the market?
This is a great question. Man, this is one of those times I wish I had Brian just to whip out a great, like an even better response for you. But I'm going to say the power of multitude of numbers, the power of counsel, to
Mm,
really assess what it is you're moving into,
mhm,
because you might not need 100% of your portfolio to be 100% liquid for you. So
mm,
that would allow you to have a proper range of, like I said, a medium, a high, a lower risk. And that, even some of that stuff that really should just be sitting in your savings account that you don't mind that it's getting such a negligent amount of return. and you need to figure out what that is. But also understanding life is weird. Life is unexpected, and you're going to have to figure out what that looks like for your portfolio, for your family, for your estate, for your future. And I think making sure that whoever it is that you're talking to has been doing this for long enough, but also they're making more money than you've ever made in this. Like, I don't want to talk to somebody that's brand new in this, unfortunately. I want to make sure that I'm talking to a seasoned pro that's been through a few highs and lows, a few black swans, right? A few of the recent crashes that we've had to make sure that they're not just pie in the sky. There's glitter and rainbows for everybody, but like a realist about what your
Absolutely.
account's going to do.
Absolutely. And what an amazing piece of information you've given me. But on that note, Tiffany, I just want to say thank you so much for this absolutely incredible conversation. I mean, I thought I'm a reasonably savvy investor, having been investing for over 50 years around the world. But I think I picked up some very interesting tips from you today. And I'm sure my viewers and listeners will learn a lot from all the amazing investing 101s that you gave to us. And of course, how important it is for us to be able to balance any portfolio that we are in. Thank you for speaking to me and good luck to me.
Thank you.
Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website www.tbcy.in to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the Brand Called You.